What looks like financial chaos from a distance often turns out to be a rotation of trust underneath the surface of the economy. Because money rarely disappears all at once, it moves between assets depending on what people fear losing most at a particular moment in history. During periods of stability, investors usually prioritize growth and productivity. Yet the moment uncertainty enters, inflation, banking instability, war, debt crises, or political shocks, the collective psychology surrounding money begins to change. Most people assume these asset classes compete directly, but historically they behave more like different forms of protection against different kinds of fear. Stocks represent confidence in future productivity. Gold represents distrust in financial systems. Real estate represents tangible long-term security. Understanding this distinction explains why one asset can rise while another weakens without requiring the entire economy to collapse. The modern investor often experiences economic stress as a series of headlines, interest rate announcements, inflation reports, and market volatility. But beneath those events sits a deeper psychological mechanism driven by uncertainty. Human beings constantly evaluate where safety exists. When inflation rises aggressively, people start questioning whether cash itself will preserve purchasing power. Holding currency suddenly feels like holding a melting asset. Gold occupies a unique psychological position in human civilization because, unlike stocks, it does not depend on corporate earnings. And unlike real estate, it does not require tenants, maintenance, financing, or local economic activity to maintain its symbolic value. Across centuries, gold became associated with permanence precisely because it exists outside many institutional promises. During periods of severe uncertainty, people often move toward assets that appear detached from political systems, banking structures, or debt expansion. This behavior appeared repeatedly during inflation shocks in the 1970s, banking fears during the 2008 financial crisis, and more recently during currency uncertainty and geopolitical tension. At the same time, real estate reacts differently because housing sits at the intersection of psychology, necessity, leverage, and demographics. People need shelter regardless of market cycles, which gives property a certain foundational demand. Yet real estate is also heavily influenced by credit conditions because most buyers rely on borrowed money. If inflation rises moderately while wages remain stable and interest rates stay relatively low, real estate can appreciate strongly. However, when central banks aggressively raise interest rates to control inflation, borrowing becomes more expensive, monthly payments rise sharply, and housing affordability deteriorates. This relationship explains why real estate booms often emerge during prolonged low-interest rate environments. Cheap credit expands purchasing power artificially because buyers focus primarily on monthly affordability rather than total asset valuation. Yet this same leverage mechanism creates fragility because higher rates later reverse the affordability equation. The housing market therefore becomes deeply connected to monetary policy. Stocks operate through yet another psychological framework because equities fundamentally represent ownership in future economic output. When investors buy stocks, they are betting that companies will produce increasing profits over time. During optimistic periods, investors tolerate higher valuations because they believe future growth will justify present prices. Markets attempt to price future expectations long before ordinary economic indicators visibly improve. However, stock markets also react violently during economic stress because uncertainty damages confidence in future earnings. Rising inflation can increase corporate costs, higher interest rates can reduce consumer spending, and recessions can shrink profits altogether. Once investors begin doubting future growth assumptions, stock valuations compress rapidly. This is why stock market declines frequently feel emotionally disproportionate compared to the news itself. One of the most important historical patterns appears when comparing how these assets behave during different types of crises. During deflationary recessions, investors rushed toward cash and government bonds because liquidity became more important than inflation protection. By contrast, during inflationary stress periods, gold often strengthens earlier because the concern shifts from contraction toward currency erosion. This distinction matters because many people misunderstand financial history by searching for one permanent safe asset. There is no universally dominant asset across all environments because every asset protects against a different type of economic pain. Stocks compound value. Gold preserves trust. Real estate provides utility but is vulnerable to financing conditions. The deeper lesson underneath these cycles is that economic stress changes human time horizons. During prosperity, people think long-term. During uncertainty, people shorten their horizon dramatically because immediate protection becomes more important than distant growth. Markets are therefore not only financial systems but emotional systems operating at massive scale. This becomes particularly visible when ordinary individuals begin changing behaviors simultaneously. Investors who once prioritized growth stocks suddenly prioritize dividend stability. Families delay home purchases, central banks alter interest rates, institutions buy gold for diversification. These behavioral shifts interact continuously, creating feedback loops that amplify price movements. Modern economies add another layer of complexity because digital information spreads fear and optimism at extraordinary speed. Social media accelerates emotional contagion, financial news cycles amplify uncertainty, and retail investors participate at unprecedented scale. Modern asset movements often appear faster and more emotionally reactive than historical parallels. Yet despite technological change, the core pattern remains consistent. When societies feel optimistic, stocks dominate. When inflation rises, gold regains importance. When people prioritize tangible security, real estate attracts capital. These rotations reflect changing definitions of safety inside the human mind. Understanding this framework does not eliminate uncertainty or predict markets perfectly, but it changes how financial stress is interpreted. Every major asset class tells a story about what society currently fears, trusts, or expects from the future. And perhaps the most important realization is that financial markets are never purely about money itself. They are about human behavior under changing conditions of stability, scarcity, confidence, and fear. Gold, real estate, and stocks simply become mirrors reflecting which form of security people value most at a particular moment in history.